The broadcast is now starting. All attendees are in listen-only mode.
Hi, Sandy Vicani with Insurance Agency Marketing. I head up and oversee our life division here at IAMS, and I just want to say thank you so much for everyone taking time out of their schedule, especially on a Monday morning, to attend such an important webinar. Truly, can't say enough about the company and about the co-host, Marty Smith. So excited to get started. I will go ahead and go through a couple slides first and then hand it over to Marty. Wanted to let everyone know with IAMS, if you refer an agent over to us and that agent contracts, we will send you a $50 check as a thank you for referring that agent. If that same agent writes and places business with us, you get 20 basis points off of each piece of placed business that agent does, and that's indefinitely. And that doesn't come out of your commissions. It doesn't come out of that referred agent's commissions. That comes directly from IAMS, and that's, again, for us to say thank you so much for entrusting that agent with IAMS. For all agents, we have a marketing reimbursement account, and in that marketing reimbursement account, we put in $100 for every $100,000 of premium that you place with us. So whether it's life, annuity, MedSup, long-term care, combination thereof, we will, to get to that $100,000, we'll put $100 in there. So for example, you submit a business invoice to us, whether you had purchased a computer, did a seminar system, purchased website, we pay up to 50% of that invoice as long as that money is in that marketing reimbursement account. We also have, for every new producer, we have something called a new producer builder. So in your first 6 months of getting contracted with IAMS, if you place $100,000 of business with us, in addition to that great marketing reimbursement, we will give you a $750 cash bonus, or you can choose a 2-year producer website. If you'd like to hold off and you think, gosh, I'm going to place $300,000 of business in my first 6 months with IAMS, you can choose a $2,000 marketing reimbursement, $1,500 gift card, or a Social Security seminar program and 3,000-piece mailing. If you think, gosh, I'm going to go gangbusters my first 6 months and place $500,000 with IAMS, you'd like to hold off till then, you can choose a 4,000-piece mailing and seminar coaching with a top producer of ours, Dave Pimper. You can choose a 5,000-piece mailing and seminar coaching with another great top producer of ours, Matt Gill. Or you can choose my favorite, and it truly is my favorite, is a Ritz-Carlton Travel Rewards Getaway, where you plan your own travel destination. And again, this is in addition to the marketing reimbursement and your great commissions, just as a way for us to say thank you. We also have strong back office support, trying to save you some time so you can go out and do what's so important, and that's to get business in the door. So we will help you with different tools and resources, whether it's case design assistance, sending out any forms that you need, doing any quotes, whether it's on the life or the annuity side. We also have great coaching and sales expertise. And then when you do get contracted with us, we set you up on a paperless system. So there's not a time where you have to go back and fill out contracting paperwork. I think out of all of this, the most important is the submission to commission. What we do here at IAMS is we are extremely aggressive in the underwriting process, both life and annuity. What we do is we will scrub your applications, make sure there's nothing missing that would hold up the underwriting process, submit it to the carrier the same day, and follow it through the underwriting process. Every 3 days, we're touching that case until you get paid your commission. We just want to make sure things go smoothly and nothing gets derailed. So again, we do follow up every 3 days on that case. We have a strong marketing team, whether you're speaking with Jacob or whether you're speaking with Sean from our creative department. They can help you with handouts, different flyers, and newsletters. If you have a logo design and it just needs to be refreshed, or you don't have one, we can create that for you. Same with business cards, online newsletters, and a website. Again, if you need a refresh on your website or you don't have a website, IAMS can create and manage that for you. Also, what's really big right now is social media. Gosh, if you aren't comfortable or aren't that familiar with getting around Facebook and for advertising, we can help with that. So Facebook is just real strong right now with advertising, and we can help you do that and get your name and your agency's name out there. We also have a real strong website. I am in this website every single day, all day long. It is www.iamsinc.com. On this website, you're able to run quotes, whether it's term quotes or UL quotes. You're able to pull forms. You're able to sign up for our webinars and see what our webinar schedule looks like, as well as view any of our recorded webinars right there in our library. We also have different forms and training support for you. So if you're not already registered for our website, can't stress enough that you get registered. Look at the information, current annuity rates, good industry links, about everything at your fingertips right there. I'm going to put out a poll question right now, and answering yes to this is just asking for additional information. So when the DOL ruling came out and, just through the industry and chaos, we thought it was really important for agents to know that with IAMS, they can keep as much business as they want through themselves and here through IAMS. So we created an IAMS Wealth Management. And now that the DOL ruling has changed, we still think it's just so important to give you options and to increase your revenue, whether that's managed money fees. You're now able to offer your client a full range of products and services. And you're viewed completely differently by your clients. You're now viewed as a fiduciary. So instead of your clients going outside of you to complete their investment needs, they can stay with you and just go full circle again with retention, with relationships, and more importantly, with your revenue. If you think, gosh, I need a Series 65 with this, let us show you how, if you don't want to get that, what you can do to, again, keep that business here in-house. So I'm going to wait just a little bit longer until we can get some more responses here. And again, if you think you need a 65, you would be surprised at what we can do to keep that business without you having to go out and get that. And again, we'll answer those questions for you. So I'm going to move on here. And we have our Life and Annuity Academy. Our Life and Annuity Academy, again, I'll put out another poll question. This is industry recognized. We're just so proud of it. We had close to 1,000 agents apply. We take between 35 and 40. Our next academy is October 17th through the 19th, and we pay for everything. We pay for your airfare, your lodging, your meals. It is a 2-day packed training that includes different sales ideas and strategies. We go over indexed annuities and when's a great time to use them, as well as when to use those income riders. We go over different industry threats and trends and how it's affecting the business and how it will affect you. Different seminar systems. Whether you're looking at, cookies and coffee in a library, which we've had a lot of success with some agents, or whether you're looking at more formal seminars with a sit-down dinner. We go over life insurance and large life case marketing, whether it's single premium life or whether it's with that great infinite banking concept. We also go over different insurance concepts. How to get over client objections, wealth transfer tools. Again, we pay for everything. There is not an expense to you. October 17th through the 19th, we would love to answer any questions you have, see if it's a good fit for you. I can't stress enough the amount of agents that would love to attend this. By answering yes to this poll question, we're just sending you more information. We're not signing you up for anything at all. I'm going to go ahead and get that closed. And then with IAMS, in addition to security mutuals amazing trip that they're having next year or any other carrier, we here at IMES, in addition to that, offer our own trip. And next year will be to the Ritz-Carlton in Naples, Florida. It's our 2019 IMES Marketing Summit that happens August 25th through the 29th for you and a guest. We want to make sure we can get just as many people there as possible, so we have long invitational periods from January 1st 2018 through June 30th, 2019. You are eligible with a combination of, you can do $3 million in annuity premium. You can do $1.5 million in Med Sup. You can do 2.2 with single premium life. $250,000 with life target premium, or $600,000 for long-term care premium. And again, this is for you and a guest. Only way to get there is to start getting contracted and write business with IMES, and we would absolutely love to have you and as many people there as possible. So what I'm going to do now is turn it over to Marty Smith. Can't stress enough the relationship that IMES has with Security Mutual. We're grateful for their relationship and their help with agents. Marty cannot be a better person to go to for any questions that you have on how the products work. Just great source for everyone. So I'm going to send that over to you, Marty.
Very good, Sandy. Very good. Are you able to see my screen?
We are.
All right, excellent. Then I'm raring to go. All right, so today, again, for those of you who don't know me, I'm Marty Smith. I'm the Regional Vice President with Security Mutual. Security Mutual Life Insurance Company of New York is probably the biggest small company you'll ever want to deal with. It's up in Binghamton, New York. I'm located in our New York City regional office, which is kind of nice since I live in Manhattan. Security Mutual's been around 132 years. We paid dividends for the last 126 consecutive years. We operate out of the same building in Binghamton, New York since 1904. I always make the joke that we only have around 300 employees, and I still think they are back from all the way in the 1900s, since we have such an experienced staff. So last time I spoke, last Monday, I was talking about the riders that we attach to our whole life products to make them sing and do amazing magic tricks with the infinite banking concept, or just as cash accumulation products. What I want to do today is, the title of the presentation is Be Creative and Flexible with Whole Life. Whole Life is my passion. I think it is the best financial product that's ever been created. What I intend to do today is give you a base primer. Now, obviously, I do speak to a lot of agents. I understand what they know and what they don't seem to know about whole life. So what I'm trying to do today is give you a primer about just using the base premium and show you how it affects the whole life product in terms of dividends, cash values, death benefits, when it'll offset, the different types of dividend options that you have. So waiver of premium, there's a whole host of things, and I'm going to take you through this hopefully in the next 35 to 40 minutes here. And what I'm going to use to describe this is Security Mutual has 4 whole life products. And I think you can apply this to other companies that you use, just to see limited pay products versus pay all products. All right. So let me begin like this. Security Mutual, we call our products Whole Life for You. We have a 121 product, meaning that's our low cost premium product that you could pay until age 121. Our LP 100, where no further premiums are due after age 100. Our LP 65, again, paid up at 65, and then our 10 pay. The whole point about the whole life products is we believe that these designs offer you a tremendous range of flexibility, and I'm going to prove that to you as we go along here today. Now, everything that I'm showing is a handout, and obviously you can either contact Sandy or contact me directly, and I'll be glad to share the handout with you so that you can see the numbers for yourself, and go from page to page and compare things on your own time and leisure there. So again, what we have over here is, we have our best class non-smoker, preferred non-smoker, standard non-smoker, preferred smoker, standard smoker, juvenile, and of course we do have table rated policies from table 2 to table 16 there. What I want to point out over here in terms of issue ages, all the products are available age 18 to 80. The LP100 is available to age 85. And then we also have only 2 products are applied to juveniles. That's the LP100 and the 10 pay. So where we'll take somebody from 0 to 17. Now, the next thing I want to point out for all of you who are interested in infinite banking is our policy loans. Now, it used to be the old days that policy loans, you'd have to wait over a year to access any money that was available as cash. At Security Mutual, once we got into the infinite banking, bank on yourself, circle of wealth arena, we understood that people wanted access to cash right away. So literally, you put in cash, you put in as soon as cash shows up in the policy, it's available for you as a policy loan, meaning put money in day 1, take it out day 2, actually day 11 after the 10-day free look. We do have a variable policy loan interest rate as opposed to a fixed interest rate. Variable policy loans are associated with non-direct recognition policies. Fixed policy loans are referred to for the direct recognition. I'll explain that in a little bit there. Currently, we have a variable policy loan interest rate of 5%, and it's been 5% since interest rates have been in the lower quadrant of interest rates. We also have what we call an advantage loan benefit, which starting in policy year 20 and in each policy year thereafter, the declared interest rate will be reduced by a set percentage, 50 basis points. So that's pretty cool. So again, you'll notice whenever you're illustrating distributions starting after policy year 20, you'll notice that you'll be able to get additional monies out, or money will last longer because of the advantage policy loan benefit. And then, yes, obviously, this is a non-direct recognition policy. The difference in between non-direct recognition and direct is if you take a policy loan from a direct recognition policy, what's going to happen? Bingo. What's going to happen is the life insurance company recognizes the loan and credits less dividend to that, or they may not credit any dividend to the loan portion of the policy. With non-direct recognition loans, hey, dividends are paid whether there's a loan or not a loan. And if you want more information about that, just give me a call or shoot an email to me, and I'll be happy to tell you more about that. All right, so again, we have 5 different dividend options: cash, reduced premiums, paid up additions, dividends at accumulation, and 1-year term additions. And I'm going to show you, and this should really open up some of your eyes there, about how these dividend options work. All right, so let's do this. What I'm going to do is I'm going to go through all 4 products. I'm going to go through the 10 pay, the 65, the 100, and the 121. It's going to be in that sequence for all that we're going to do today: the 10 pay, the 65, the 100, and the 121. So the first thing I'm going to do is I'm going to solve for premium. And this, again, is going to be an all-base premium. So let's take a look for our 10 pay. So what I'm going to use is a male age 45 best class. Best class for Security Mutual is called Preferred Plus. I'm going to have an initial death benefit of $1 million. All right. So what is the premium for my male 45 best class to get that $1 million? And you'll see over there in year one, the contract premium is $40,935. So this is on our 10 pay. Notice that there are no further contract premiums after year 10. You can't pay it. It is a genuine 10 pay product. But take a look under the guaranteed values column where I have BE. BE stands for break even. This is where the cumulative premiums have broken even. Even with an all-base contract on a 10 pay, it's going to break even on a guaranteed basis in year 11. On a non-guaranteed basis, it's going to break even in policy year 9. Notice again, in the first 2 years, there are no dividends. In year 3, it's a minimal dividend, and then finally they start to build up. But even with that, with the 10 pay, it's going to break even year 10. The other thing I want to point out over here is, look at the cash value in year 10. On a non-guaranteed basis, it's $432, right? $432,000, I should say. So using the rule of 72, since no further premiums are being paid, how soon does 432,000 become 864,000? Notice going down there, it's in year 24. That means it takes 14 years for the cash value to double using the rule of 72. 72 divided by 14 equals 5.14. That is what your cash value is growing at a clip. Wow, pretty cool. Also notice during that time that your death benefit in year 10 was $1,065,000. 14 years later, it's $1,464,000. Again, the product works like a cash accumulation cow. It really builds as you do it. So now let's take a look at when we're solving for all base for our LP65. Notice over here what's going to happen. For a 65, the premium is going to be less because we have, 10 additional more years in this particular instance, since we're using a 45-year-old male. So the client has to pay for 20 years, or could pay for 20 years. The premium is $26,395 for the same $1 million death benefit. The break even under the guaranteed values is year 20. And on the non-guaranteed value, it breaks even in year 12. Notice again, the annual dividend is zeros in the first 2 years, and then it builds from that point. Let's take a look at our next product. Our next product is the LP100. Notice the significant difference now in terms of what that cash premium is there. The contract premium in the LP100, since you're paying these additional years, goes down to $18,105. The break-even point on this, under the guaranteed column, is year 25. On a non-guaranteed basis, because of the dividends, it's going to break even in year 13. I'm probably going to come back to this to show you something really cool. So if I go to our next product, the 121 all-base premium for my male 45 preferred class, the premium goes all the way down to $15,065. Notice how there are no dividends almost for 10 years. Like, what? What do those actuaries at Security Mutual think when they were designing this product? They must have been out of their minds. But notice over here, for the LP121, the break even under the guaranteed column is year 14. So think about it. It took to year 25 on the 100 to break even. On the 121 product with much less dividends, we're breaking even in year 14. Take a look again over here under the non-guaranteed column. The break even under the non-guaranteed is year 13, just like it was on the 100. So my question to you is, there's only one way to really compare companies side by side. I don't care what they say the dividend scale is. What you need to do is you need to lay those illustrations side by side. You'll hear from all the big AA+ rated companies over here that, hey, you know, we have much higher dividends, right? Dividends aren't that important. And I'll repeat that again. Dividends aren't that important. The three most important columns that you need to look at and compare on the illustration are the guaranteed cash values, the non-guaranteed cash values, and the total death benefit. Because if it takes 25 years to break even on a guaranteed basis, and over here, you're breaking even in year 14, what does that mean? Well, it just means it's the product has been engineered to be that much more efficient. Dividends aren't that important. You need to compare. It turns out, from Security Mutual's point of view, we thought the 100 with all the bells and whistles would probably be our product of choice. What we're finding is people love the 10-pay. Don't ever discount that. People love the 10-pay limited pay because you're always going to run to clients who are always going to say, hey, I don't want to pay all these years. Fine. We've got options for you. But over here with the 121, we understand now with the guarantees, this is an extremely powerful and well-designed product. All right, so what I'm going to do over here is I was solving for premium. Now I'm going to solve for death benefit using all base premium. And the base premium that I'm going to use is $100,000. So the first, again, we're going to look at the 10-pay first for our male 45 best class. Notice over here in terms of break evens, it's going to break even again in year 11 on a guaranteed basis, year 9 on a non-guaranteed. That's going to hold true for all 4 products. It's going to be the same as it was as I previously shown. But the key number I want to show you on this illustration is the total death benefit. Notice over here that the total death benefit is $2,445,000. That's for the 10-pay. Remember, you're paying it for a limited period of time. And again, just to prove my point, if you look at the cash value in year 10, it's $1,057,000. When does $1,057,000 become $2,100,000? Year 14 again, just like I said. So what's this growing at? Rule of 72, 72 divided by 14, it's growing at 5.14 at a clip. All right, now let's solve for death benefit using the LP 100. Remember, we're going to have to pay additional years here, actually 20 years in order to do this. The break evens are exactly the same, but what's the death benefit? 3.796 million as opposed to 2.445 million with the 10-pay. That's something that we would expect. Now, take a look at the LP 100. If we put in money for the LP 100, what's it doing? Well, the break-evens, again, are going to be the same. But what's the death benefit here? Take a look in year 1. The death benefit is $5,542,000. Pretty good. What was the 10-pay? 2.4 million. What was the 65? 3.79 million. Now we're up to 5.5. Hey, listen, if I took my wife to the appointment to see you as an agent, and you said, hey, Marty, I'm glad you're going to put $1 million into this contract here. We got 4 choices. You know what my wife would say? Take a look at the LP 121. What is the total death benefit on the 121? It's 6.666 million. You know, my wife would say, you know, husband, you need to keep paying that $100,000 because I'd prefer to have 6.6 million as opposed to 5.5 or 3.7 with the 65 or 2.4 with the 10-pay. That's the way that this works here. Look at the range there in terms of death benefits that you have. If you haven't thought about it before, think about it now. There is tremendous opportunity by just using the right product for that. So now what I want to do is I want to show you the effect of the waiver of premium when solving for premium. You know, the funny thing was I sent this into compliance, and the compliance officer called up and said, "Hey, Marty, you know, what is the effect of waiver of premium when solving for premium?" I said, dude, you have to understand the waiver of premium is a pure insurance component. It has no effect on dividends, cash values, or death benefit unless you take part of the premium to pay for the death benefit. So here we are. We're going to take a look at the 10-pay right now. So on the 10-pay, there's the $1 million base policy death benefit. There's our $40,860. There's our $75 annual policy fee for our total death benefit of $1 million. Can anybody tell me what the waiver of premium is for this? Take a look, waiver of premium on the base policy. It's $140. So the question is, would you pay $140 to preserve you being able to pay $40,000 as the annual premium? You'd be crazy not to. You'd be crazy not to do this. What is the percentage there? You'll see in a minute. All right, now we have our LP65. What is the waiver of premium for the $1 million death benefit with the $26,000 premium? Waiver of premium, notice over there on that line, it's $250. $250 is less than 1% of $26,000. Wow. Should you put it on? You'd be crazy not to put it on the policy, the waiver of premium. Now what we have over here is our LP100. Take a look at the spec box over here. Notice again that the premium is $18,000 with our $75 annual policy fee. What is it? The waiver of premium in this particular instance is $800. Wow, pretty neat, pretty neat. And then again, if I go to the 121, the waiver of premium is going to be $660. Now, if we were going back and forth, I would say, hey, how come the lower premium products have higher waiver of premiums? And the answer is simple. Because they are ongoing premium products, the life insurance company is on the hook to pay that actual premium. The company's on the hook to pay $15,000 of this premium till age 121 if you happen to live to it. And if you do happen to live to age 121, you're going to have all the cash values that you would have had as if you actually paid the premium. You have access to the cash, you have the death benefit, you collect all the dividends. Again, think about this for your clients. It makes a lot of sense to put it on. For the limited pay products, I'll say it again, you'd be crazy not to put it on. For the ongoing premium products, you have to know your client. But again, is it worth the money in order to do that, just in case? Remember, again, statistically, you're much more likely to have a disability than you are to die in your productive working years. All right, so what I'm going to do just to show you that this works there, and so if you're not good at percentages, whatever, using 100,000 makes it a lot easier to do that. So what is the effective waiver of premium when solving for death benefit? So this is what I'm going to do over here. I'm going to take a look at the 10-pay. I'm going to show you the spec box for that 10-pay. Remember, if I put in $100,000, it's going to buy that $2.4 million of death benefit. What is the waiver of premium? It's $341. Think about this. You're the surgeon. You injure your hand in a car accident, right? The next year, you can't perform the duties of a surgeon. Security Mutual Life has a 5-year ONOC definition of disability. So what that means is you need to, if you put on the waiver of premium for $341, Security Mutual Life is going to pay that $100,000 premium for the next 5 years. If you get in another car accident and you're totally disabled after that, we're going to pay for the next 10 years there, just because of that $341. You'd be nuts not to put it up. Let's take a look at the one at the LP65. The LP65, remember the death benefit is in 3.7. The waiver premium for that is $940 a year. What that really is saying is that's 0.94%. It's less than 1% in order to protect that $100,000 premium for the next 20 years. If we go to the LP100, let's take a look at the spec box. The premium, again, because of the ongoing premium, is $4,245. If I go to the LP100, just so you can compare, notice it's going to be a few bucks shorter. It's going to be $4,214. So again, you have to understand what the waiver of premium can do. The cash values aren't going to change, right? The dividends aren't going to change. The death benefit's not going to change. It's just going to protect your client in case of disability. And with Security Mutual, it's a 5-year ONOC disability to start off with. All right, so now let's take a look at the premium offset. What do I mean by premium offset? I mean, how soon can the policy, let me backtrack. There are 2 ways to pay the premium in a whole life contract. The first way is out of your pocket, and we see that under the premium outlay column. The other way to pay is by an internal mechanism. At Security Mutual, it's paid up additions surrendered, right? So based on the dividend scale, when will a policy be able to pay for itself without any out-of-pocket premium payments? So I'm going to start with the LP65. So the LP65, remember the premium was $26,395 for the $1 million death benefit. And what this indicates over here under premium outlay is that after year 15, no further out-of-pocket premiums are due. If you're careful enough, and again, that's why I suggest you get the handout, notice over here what the dividend is. Notice the difference in PUA surrender value. Notice it was 81,000 in year 15. Now it's down to 69,000. All right. The premium is getting paid how? Through an internal mechanism. We're going to use the dividends and we're going to surrender PUAs in order to do that. Hey, let me ask you a question. How come I didn't have the 10-pay product here? All base. When can the 10-pay offset? Guess what? It can only offset in year 10. That's it. If you add some paid up additions to it, it might be able to offset sooner, but with an all-base contract on the 10-pay, expect to pay for 10 full years. All right, let's go to our next product, the LP100. So when will the LP100, based on the current dividend scale at Security Mutual, offset? And if you take a look over here, notice that after year 16, that's when it will offset. All right. Now, what's going to happen if you allow the premium to offset and you don't pay any future premiums? What's the effect going to be on the dividend? Well, the dividends are going to be lower because you haven't capitalized the contract. What about the total surrender value? Well, if you don't pay premiums, you can expect surrender values are going to be lower than if you paid the premium. And the same thing goes for the death benefit, right? You need to capitalize the policy to maximize dividends, maximize surrender value, and maximize your death benefit. All right, now we'll take a look at the LP121. Remember, that was the $15,000 premium for the $1 million death benefit. And over here, it would take 21 years based on the current dividend scale. And let me ask you this. Do you think the dividend scale is at the highest it's been in a long time or the lowest it's been? Obviously, it's been at the lowest point because of interest rates. What people have to understand is we're in control of paying the premiums there. It's just a question of how you design the policy. If I design this policy with paid up additions as opposed to an all-base contract, I'm going to have more control than if I use an all-base contract, right? That's why we love the infinite banking concept. That's why we talk about it all the time, because what we want you to be able to do is find a vehicle that you're going to be able to park your money in that's going to offer you a tremendous host of benefits that you're not going to be able to find in other financial products. That's what the dividend paying whole life contract is. All right, so now let's look at the effective premium offset. And again, I'm just doing this so that you understand it doesn't matter what the premium is. It's a function of how dividends are paid in this particular instance. So what I'm going to do over here with my LP65, I have the $100,000 premium. There's my $3.796 million death benefit. Just like it did before for the LP65, it's going to offset after year 15. Pretty cool. All right, if I go to the LP100 with my $5.5 million death benefit, it's going to offset again after year 16, right? And then finally, over here with my LP121, it's going to offset after year 21. You know what my wife would say? She would say, hey, I don't want the dividend to go down. I want to maximize that death benefit for whom? Well, certainly for herself if she's still around, but certainly for any of our children, for our heirs, for any type of charitable contribution that we want to make. You have to put your money somewhere. Why would you stop paying your life insurance premium? Especially when you know how it can grow substantially all through the years. All right, so now let's take a look at something people don't normally consider, and that's the effect of the different dividend options. So what I'm going to do is I'm going to choose one of our products, the LP100. I'm going to stick with our male age 45 best class. I'm going to use the $100,000 premium, all base premium. And this is going to look familiar to how we've used this before. All right. And notice over there on the right-hand side under a life insurance illustration, it says total initial premium, premium mode, riders included, initial dividend option, PUA. So that means I'm purchasing paid up additions. I'm going to go now to year 25 to give you a good view of what this looks like, right? So if we look over here, notice at age 70, year 25 in this particular instance, what is the annual dividend? It's $113,384. I'm still paying the premium, correct? So I'm still out-of-pocket premium paying it. My total surrender value is $3.9 million. Wow, pretty cool, right? And my death benefit has grown from 5.5 million to 7.7 million. Look at the year before this. What was my cash value the year before that? It was 3,644,000. I put in 100,000, and what did my cash value go up by? My cash value went up by almost $260,000. Where else? This is why we talk about this being the parking place. Where else can I put $100,000 and in this particular account, my account goes up by 160,000 more than what I put into it? What kind of bank account are you going to have in order to do that? What kind of interest rate is going to have to be at work in order for you to have that happen, right? This is why we do this, all right? All right, so now let's take a look at our next dividend option. Our next dividend option, notice it says reduce excess paid up additions. What this really says over here is we're going to take our paid up additions and we're going to reduce the out-of-pocket premium that we paid. And in order to prove that, take a look at annual dividend year 3. Annual dividend in year 3 is $831. If I subtract $831 from 100,000, take a look at the premium outlay in year 4. It's $99,169. If I added 99,169 plus 831, that equals my $100,000 premium, right? So again, what happens in year 4? What's my dividend? 2,605. What's my premium in year 5? Well, it's 100,000 minus 2,605, which is 97,395. And that's how it works throughout the entire time that we have it. So if we look down here at year 25, notice how we don't have $113,000 in dividends because we're paying less out of pocket into the policy. What is my actual premium outlay in year 25? It's only $20,000, right? This is the way that people used to think about this. Hey, this is what agents years ago would say to their client. Hey, listen, you don't have to pay $100,000. We're going to take the dividend. We're going to offset the amount of out of pocket that you have. But notice what the effect of that's going to be. Instead of having $3.9 million of cash value, I only have $2.5 million, right? What is my guaranteed cash surrender value? If you look under guaranteed values year 25, oh, it's $2,509,000. So I'm only, 85,000, right? 84,000 above of what the guarantees would be. Look at my total death benefit. It's as if what I'm doing is I'm just taking what the guarantee is going to be. Interesting. Would we suggest you do that? We would suggest you do what your client would desire from you. But again, educating your client to understand what happens in terms of the contract here. Now take a look over here. This is our third dividend option in cash. So what would happen over here in terms of dividend options, in terms of cash? Notice, well, you can't notice. I could go back to the previous screen, and you'll notice that the annual dividends are exactly the same. The premium outlay is the same. Total surrender is the same. Total death benefit is the same. Now, what this means is the actuaries can't imagine somebody taking their dividend and using that as pure cash, right? But theoretically, you could take your dividend in cash, but you would be on the hook to pay the full premium. But if you did take the dividend, what would that look like over here? Well, your cash value is going to be lower and your death benefit's going to be lower because the dividends aren't buying any paid up additions, and their paid up additions also, remember, create their own dividends too. So there's two different ways to get dividends in the contract. By using paid up additions, surrender value, of which the company pays dividends on, and this. So it's kind of interesting how it all works together. All right. The fourth dividend option is called dividends at accumulation. Now what this is, the company will keep your dividends and credit a certain interest rate and send you a 1099 for the interest that it's paid you, and you would have to obviously pay taxes on that. Notice over here, the way the actuaries have set up the illustration is to indicate that, oh, well, this is what the dividends are going to be. But again, they're not inside the policy, they're outside the policy. What they've tried to do with the illustration is combine it so it would look like, hey, listen, if you surrendered the contract in year 25, you would get 3.6 million. The death benefit will be 6.6 million also. All right. But again, when I did this presentation to a large group of agents, I said, how many people use this dividend option at all? Nobody uses it. So it's something that might have been done before. It hasn't been in use for a long time, or it's available, but people don't use it. The fifth and final dividend option is OYT. OYT stands for 1 year term. So what this says over here is that your client can use the dividends to buy 1 year term based on their attained age and underwriting class. So notice how the death benefits are just incredible. Because think about it. If I was 70 years old, let's go down to year 25. If I was 70 years old and I took $83,631 and I bought 1 year term with it, it would buy, in addition to the death benefit of $5.5 million, an additional $11 million. Wow. So think about this. Remember, sometimes you'll go through underwriting and your underwriter will say, hey, you know, the client doesn't qualify for all this death benefit. Well, guess what happens over here? If you choose the 1 year term option, you can greatly ramp up what the total death benefit would be. Again, what's going to happen is your cash surrender value is not going to grow. It's going to look more like the guarantee, but you do have this option. And remember, your dividend options are changeable, right? We don't have split dividend options, but say like in year 20, could I start using my dividend to buy a 1 year term? Yeah. So think about it. Your clients have lots of options. If you want to discuss that more, give me a call when you have a chance. Okay, so I said, what is the effect of premiums paid in advance? Security Mutual has a premium paid in advance account. What that means is we'll allow you to drop in a single sum of money and allow you to pay a discounted premium. So to show you how that works, I'm going to use our Security Mutual Life 10 pay for my male 45 best class, right? We've seen this before. I'm going to put my $100,000 in. It's going to buy $2.445 million of death benefit. But let's say the client said, hey, listen, I hate the idea of having to be reminded about paying premiums. Can't I just give you a lump sum and consider this thing paid up? Well, you could give the company a lump sum. We put it in our premium paid in advance account. It's a GIC. It's a guaranteed investment contract. It's currently paying 2.75% guaranteed right now. Compare that with some CDs you might have out there. So if I'm going to do this to pay a discounted premium, well, I wouldn't have to put in $1 million. I could put in less than $1 million. So if I work backwards based on my 2.75% guaranteed interest rate, take a look over here under total premium outlay, including my PPIA, premium paid in advance account. I'd only have to put in $887,768. Wow, pretty cool. Notice in the column right next to it, it says PPIA account value, because again, what's new, not used, is available over there. That's the $809,000 is going to pay the next 9 years of premiums, correct? Until it's all paid up, right? And then my total surrender value is going to include that. Now, people say, hey, this is great, but what happens if interest rates go up? Well, if interest rates go up, this is a unilateral contract. You just take your money out of the PPIA and get a better interest rate somewhere else. The only difference is that you will then at that point in time have to pay the $100,000 contract premium out of pocket. All right? Understand that. You can't take part of the money out of the PPIA. It's an all or nothing deal. But again, you are in control because you could always take out money, take it all out, or end that contract anytime that you want. All right, so the other way to take a look at this is what is the effect of premiums paid in advance if you wanted to pay the full premium? So the question is, what if the client says, no, I don't want to pay a discount. I want to put in the $1 million. So if we take a look over here, we'll notice that if the company accepted the $1 million based on the 2.75% interest rate, we would then, instead of crediting $100,000, we would credit $112,642 into the contract. So again, we paid an additional $126,000 into the contract. If you go back and you compare the surrender values versus the total death benefits from the discounted premium to this, you'll notice obviously the more money you put into the contract, the more you capitalize it, the greater the surrender value, the greater the death benefit. Pretty cool. And just to prove it again, and look at the cash surrender value in year 10. The cash surrender value here is 1.19 million. When does that become almost 2.4 million? Again, rule of 72. Look down, year 24. So there's my 5.14% based on the current dividend scale for the 10 pay. Pretty nice. So let me sum this up with a few simple observations. With Security Mutual, our 4 products, the 10 pay, the 65, the 100, and the 121. When solving for the same face amount, you have a wide range of premiums, obviously, from 40,000 down to 15. That's a wide range. When solving using the same premium, you have a wide range of face amounts. Remember, the 10 pay was 2.4 million. The 121 was 6.6 million. Wow. What would your client prefer to have? What would your client's spouse prefer to have? And then again, the 10 pay has the highest premium for the lowest faced amount, except that it's guaranteed 10 pay. You can't pay after 10 years. The LP 121 has the lowest premium for the highest faced amount, except you're on the hook till age 121. The 10 pay and the LP 65 are truly guaranteed paid up products, meaning you can't pay after 10 years or after age 65. The cash values grow the fastest when? After the premium paying period with the 10 pay and the 65, right? Because there's the additional premium that is built into those contracts to sustain it all the way. And then finally, the waiver of premium is very, very cost efficient for the 10 pay and the LP 65. I would always add it since it is a limited time to pay it. And then finally, the guarantees of the LP 121 are amazing. You need to compare it and see for yourself. I'm happy to put that product up against anything you have out there, and we'll take a look and discuss it. All right? So here, for more information, for illustrations, for brainstorming cases, obviously you have your crew at IAMS to help you. But if you want to, you can always call me, and there is my telephone number and my email address. Mike Leidy is my sidekick and partner in crime over here. That's his direct number you can call. And there's Mike's email address. Tracy Leslie and Lisa Canfield are up in our Binghamton office, and they are so well acquainted and understand our products inside and out. Both have over 20 years experience with the company. So I would turn this back over to you, Sandy. This is this is exactly what we have. I hope people have been able to see that and understand it, and I'm happy to give back any, happy to answer any questions, or certainly be able to share the handout with anybody who's looking for it. All right?
Thank you so much, Marty. I want to see if anyone has questions that we can try to answer. I put a poll question out there asking if you want more information about Security Mutual. Again, I cannot stress enough the ease of this company, whether you're looking at customer service or whether you have questions, the availability of everyone to be so eager to answer those questions, run the quotes, get your cases in. We have direct contact with the underwriters. They are a great company, and I want to stress again, up to $1 million in death benefit with no exams or labs on their products. So keep that in mind. We'd love to get as many of you contracted with them as possible. Also wanted to remind everyone that you will get a recorded version of this webinar. We'll get that sent out to you later on this afternoon. In addition to Marty and his team at Security Mutual, if you have any questions at all or need any quotes ran, please give myself a call at 800-255-5055. Again, I want to thank Marty just for all the great information on the products, how to run them. We'll, of course, continue to do these great webinars with Security Mutual, answer anyone's questions that they have. In the meantime, I hope everyone has just an amazing, successful, great, and safe week. Thank you, everyone. Bye-bye.